Hey everyone, welcome to the show. We're thrilled to have you here. Today we're diving into the wacky and often bewildering world of financial crises. It's a topic that's as fascinating as it is complex. Buckle up, it's going to be a bumpy ride. Think of it like a roller coaster. You know, those rides with huge climbs, sudden drops, and maybe a loop-de-loop for good measure. The economy can be just as thrilling and unpredictable. That's basically the economy in a nutshell. Throughout history, we've seen periods of incredible growth and prosperity, times when it seemed like the good times would never end. Everyone's making money, buying fancy hats and feeling good. The streets are bustling, businesses are booming, and there's a general sense of optimism in the air, but then, BAM! Something goes wrong. The music stops, the lights come on, and everyone's left wondering what the heck happened. It's like the rug has been pulled out from under everyone's feet. These crashes, my friends, are what we call financial crises. They're like economic heart attacks, causing widespread panic, job losses, and a whole lot of finger-pointing. The impact can be devastating and far-reaching. But don't worry, we're here to break it down. We'll help you understand the causes, the effects, and the lessons learned from these turbulent times. We'll be traveling through time, exploring some of the biggest financial meltdowns in history. Each era has its own unique story and set of circumstances. From wacky tulip bulbs to collapsing housing markets, we've got it all covered. These events have shaped the world we live in today. So grab some popcorn, settle in, and let's get this financial history lesson started. It's going to be an enlightening and entertaining journey.
Our first stop takes us back to the Netherlands in the 1630s. Imagine a world where people are going bonkers for flowers. Not just any flowers, mind you, but tulips. Yes, those colourful things your grandma loves. Now, tulips were pretty exotic back then, recently arrived from Turkey. People went nuts for them. They were like the iPhones of the 17th century. Everyone had to have 1 or 10 or 100. Prices for tulip bulbs skyrocketed. People were trading their life savings, even their homes, just to get their hands on these precious petals. Some bulbs were worth more than a nice canal house in Amsterdam, can you imagine? But just like a popped bubble, the tulip craze couldn't last forever. The market crashed, prices plummeted, and guess what? A lot of people lost their shirts. It was the first major financial bubble in recorded history. And boy, was it a doozy. Next up, we're hopping over to England in the 18th century. Picture this, a company promising unimaginable riches from, wait for it, trading rights in the South Seas. Sounds legit, right? Well, not so fast. The South Sea Company was long on promises, but short on actual, trade. They hyped up their prospects, convincing investors they were sitting on a gold mine. People went wild, buying shares like they were going out of style. The stock price soared. Everyone from dukes to dustmen wanted in on the action. Even Sir Isaac Newton, the genius who discovered gravity, got caught up in the frenzy. But guess what? The South Sea Company's grand plans were about as real as a unicorn farm. The bubble burst, the stock crashed, and investors were left holding the bag. It was a stark reminder that even the smartest folks can fall for a good story. Fast forward to the 1920s, the roaring 20s, jazz music, flapper dresses, and a booming stock market. Life was good, especially in America. People were buying stocks on margin, basically borrowing money to invest. What could go wrong? Well, in 1929, the party came to a screeching halt. The stock market crashed, and it crashed hard. Black Thursday, Black Monday, Black Tuesday. It was a whole week of financial darkness. The crash triggered the Great Depression, a global economic crisis that lasted for a decade. Businesses collapsed, banks failed, and unemployment skyrocketed. People lost their homes, their savings, their hope. It was a dark chapter in human history. Let's zoom ahead to 1997. The Asian tigers, economies like Thailand, Indonesia, and South Korea, were roaring with success. But lurking beneath the surface were weaknesses like massive debt and overvalued currencies. When investors lost confidence, it triggered a financial earthquake. Currencies plummeted, companies went bankrupt, and economies contracted severely. The contagion spread like wildfire, even impacting Russia and Brazil. The Asian financial crisis was a wake-up call about the interconnectedness of the global economy. What happens in one part of the world can quickly ripple out and affect everyone. Globalization, ladies and gentlemen, it's complicated and unpredictable. Remember the late 1990s? The internet was new, exciting, and everyone was talking about dot-coms. Companies with a website and a dream were attracting millions, even billions of dollars in investment. It was the wild west of the web. Investors threw money at anything with a .com at the end, regardless of whether they had a viable business plan. Pets.com, anyone? It was pure speculation fueled by FOMO, fear of missing out. But just like a dial-up connection on a bad day, the .com bubble eventually burst. Companies went bust, investors lost fortunes, and the Nasdaq, the tech-heavy stock index, took a nosedive. And now, for the main event, the 2008 global financial crisis. Remember that one? Of course you do, it was kind of a big deal. It all started with, you guessed it, houses. Banks were giving out mortgages like candy, even to people who couldn't afford them. These were the infamous subprime mortgages. These risky mortgages were bundled together and sold off as investments, like financial hot dogs made of questionable meat. Everyone thought they were getting a good deal, but no one knew what was really inside. When the housing bubble burst and people started defaulting on their mortgages, the whole system came crashing down. Banks failed, credit markets froze, and the global economy went into a tailspin. It was the worst financial crisis since the Great Depression. So what have we learned from all this financial mayhem? Well, for starters, history has a funny way of repeating itself. Human behavior, especially when it comes to money, tends to follow predictable patterns. We get greedy, we get scared, and we make bad decisions. We fall for hype, we ignore warning signs, and we think this time it's different. Spoiler alert, it's usually not. But fear not, my friends, we're not doomed to repeat the mistakes of the past. By understanding the causes and consequences of financial crises, we can learn to make better choices. We can be more cautious, more informed, and less prone to irrational exuberance. So, how can you, the average person, spot a financial bubble before it bursts? It's not as difficult as it might seem. Think of yourself as a financial detective looking for clues. Just like a detective, you need to be observant and analytical. Here are a few red flags to watch out for. Asset prices skyrocketing. When you see prices of assets like houses, stocks, or even commodities like tulips rising rapidly, it's a signal to be cautious. When things like houses, stocks, or even tulips start going up in price at an unsustainable rate, it's a sign that something might be amiss. History has shown us that such rapid increases are often followed by sharp declines. Remember, what goes up must come down. Excessive leverage. This is when people and institutions borrow too much money to invest, hoping to amplify their gains. When people and institutions borrow too much money to invest, it can amplify both gains and losses. This can lead to a precarious situation where even a small downturn can cause massive losses. High levels of debt can be a recipe for disaster. Herd mentality. This is when everyone is jumping on the bandwagon and throwing money at the latest hot investment without doing their own research. When everyone is jumping on the bandwagon and throwing money at the latest hot investment, it's time to be cautious. Following the crowd can often lead to poor investment decisions. If your grandma is giving you stock tips, it might be time to sell. Lax regulation. When the rules that govern financial markets are not strictly enforced, it can lead to risky behavior. When regulators turn a blind eye to risky behavior, it can create an environment where bubbles can inflate unchecked. This lack of oversight can be dangerous for the entire financial system. We need strong regulations to keep the financial system safe and sound. Proper oversight and regulation can help prevent bubbles from forming and protect investors from potential losses. The financial world is constantly evolving, with new trends and shifts happening almost every day. New technologies like cryptocurrencies and decentralized finance are emerging, bringing both opportunities and risks. These innovations promise to revolutionize the way we handle money, but they also come with their own set of challenges. The future of finance is uncertain, but one thing is for sure, we need to be prepared for anything. This means staying informed and being ready to adapt to whatever comes our way. We need to learn from the mistakes of the past, adapt to changing circumstances, and build a more resilient financial system. By understanding historical financial crises, we can better prepare for future challenges. That means promoting financial literacy, encouraging responsible investing, and ensuring that everyone has access to the tools and resources they need to thrive. Financial education is key to making informed decisions. So the next time you hear about a hot new investment opportunity, remember the lessons of history. It's crucial to approach new ventures with a healthy dose of skepticism. Do your research, ask questions, and don't be afraid to say no. It's better to be cautious than to rush into something that could jeopardize your financial stability. After all, it's your money and you worked hard for it. Protecting your financial well-being should always be a top priority. Don't let a financial crisis take it away from you. Being proactive and prepared can make all the difference in safeguarding your assets. That's our show for tonight. We hope you found our insights valuable and thought-provoking. Thanks for joining us on this wild ride through financial history. It's been an enlightening journey and we appreciate your time. Remember, knowledge is power. And with a little bit of financial savvy, we can all navigate the ups and downs of the market with confidence. Stay curious and keep learning. Stay informed, stay skeptical, and until next time, stay financially fit. Keep an eye on the market and don't forget to take care of your financial health.